Welcome to Partnered Up Business Law, Deals, and Dynamics.
Hey everyone, welcome back to an all-new episode of Partnered Up Business Law, Deals, and Dynamics with Jeff Fink, a partner over at Corin Lichtenstein LLP out in Massachusetts. I am your host, Mike Leon. You know, Jeff has been advising business owners and partners on formation, growth, and dispute resolution for closely held companies. And in today's episode, we're going to be talking about kind of what goes into an LLC operating agreement. There's so much to talk about that we're going to break this up into 2 episodes, and Jeff is going to break this all down in just a sec. You know, Jeff, it's good to see you as always. So let me ask you at a high level here, like, give us an overview of what we're going to be talking about today when it comes to starting an LLC and an operating agreement.
So first off, thanks, Mike, for having me. It's great to see you again. When we started thinking about this episode, we thought, we can just go through an LLC agreement and pick out the highlights and say a few minutes about each one. But there's so much there, and this is really intended as an overview. We did have to break it into 2 parts. A lot of these topics will need a full episode to discuss, but we'll get to that. Some of them we've already covered. So that's kind of where we're approaching this from. So big picture, what is an operating agreement? Why have it? What goes into it?
Yeah. Well, let's get into it. You said it all there. Let's start with the first thing that you just said. Why is it important, or is it important for LLCs to have a written operating agreement? What happens if someone's like, I don't need an operating agreement?
So you can do that. The statutes, and every state has its own LLC statute. They're a little different. There is something called the Revised Uniform Limited Liability Company Act that we actually don't have in Massachusetts. Really, there are 3 states that we see the most: Mass, Delaware, and New York, and they're all different. But the statutes have answers to a lot of the major questions that come up if you don't say anything about it. The problem is that whatever the law implies generally isn't what people want, or at least not the whole package. So it's not really a one-size-fits-all situation. It's really much better for filling in the gaps than for being the whole thing.
Jeff, what are some of the general matters that people start including in these operating agreements? Statutory requirements? Is there more general, maybe boilerplate provisions? Like break it down for us.
So there's always boilerplate. Lawyers love their boilerplate. Part of it is the usual contractual stuff, specifying what law governs and that third parties can't rely on it and things like that. There's also some statutory stuff that you have to talk about, and this is pretty much the same everywhere. You have to have a registered office for the entity. You have to have something called a registered agent, which is somebody who, if somebody wants to sue you, they can serve process on that agent. Something we used to worry about, currently don't, is the Corporate Transparency Act, which there's been a lot of talk about that over the last 5 or 6 years. It's not currently applicable to most LLCs, but one of the questions there is, can you bind your members to give you the information you need? So even though the regulations exclude most LLCs now, we still tend to put in a provision about that, about how you have to provide information. And certainly, if you're in a regulated industry where the regulators are going to look at who owns the LLC, you're going to want to include that same kind of information about how the members have to provide info to the company in order to provide it to the regulators.
Jeff, can I ask you on the operating agreement fronts, how do they kind of address the capital contributions? Like, who's putting in the money, how much? How does the operating agreements account for that?
So it's a really complicated topic. And it's the heart of the economics, is who puts in how much money and who gets money out. And there's also a tax thing we'll talk about in a minute. So usually, if you have a written agreement, it'll specify what goes in and who puts it in and under what circumstances. And sometimes it's cash, sometimes it's assets, sometimes it's intellectual property. But the agreement will spell all that stuff out. Different people may put in different things. There are questions that come up like, is it a one-time contribution? We each put in $100 and we create a company and it goes forward. Or is the idea that you have to keep putting money in under certain circumstances? That's usually the case in like LLCs that are set up for investment purposes. They'll have a provision for something called a capital call, where the managers will say the members will commit to putting in a certain amount of money, and the managers will say, okay, now it's time to put it in, and you've got to put it in. And then to make things complicated, you get to questions of what happens if you put your money in, but somebody else doesn't. Do you get diluted? What's the penalty for the other people? Um, uh, and then you have questions about who gets to make that decision that the business needs more money and that everybody's required to put something in, or else there's consequences. Again, usually it's managers. Sometimes it's the members, but it can get messy. But because when you're going into a company, you want to know, okay, what's my maximum liability? And I just got an email this morning from someone saying, we set one of these things up. What happens if somebody sues me and the LLC? Well, usually the LLC is going to block that unless you've got provisions in there that say you have to put in your money for certain purposes.
Everybody wants to know where the money's coming in and where it's coming out, right? That's the first thing I think businesses would want to know. So, can I ask you, because you mentioned about the tax part, like how do the operating agreements handle not only the distributions and allocations, but like how members are taxed, how the profits are divided? Break that down a little bit more as well.
That's the messy bit. It's the most complicated business arrangement, and the part of the operating agreement that, even though it's so important because you want to know when you get your money out, most people's eyes start to glaze over when they get to that. So in its simple form, you have some operating business that's in an LLC. You have two people put their money in, and everybody puts in the same amount of money. Everybody gets their money back at the same time. There are no weird circumstances. All is perfect. All is clean. Rarely happens that way because life is messy. So more often than not, there's most to it. There's a word that people throw around called a waterfall. So in a waterfall, which is how the distribution provisions work, one group gets this amount, and then the next group of members gets this amount, and then the next group of members gets this amount. And sometimes you go back to the first group and have them get pieces. So again, think of a simple case here. If you have one manager and one member who's kind of a silent partner, which is not an unusual structure when the silent partner member is just as an investor. They put up money. Usually they're going to get something called a preferred return, which is it's kind of like interest on their money, and that comes out first. They may get all their capital out first before the manager gets anything. The manager may then get something called a carried interest, which is something that it's basically paying them for their services. They'll get 20% of the profits, then and there upfront, and then everybody gets their money back. Sometimes you flip back and forth. So you'll have for the preferred return paid to the investor, and then the manager gets a makeup, and then the manager gets their carried interest, and then everybody gets their capital back, in accordance with their ownership percentages. It may be different if the company is being dissolved. The investors will usually want their money back first. It's called liquidation preference. But yeah, spelling all that out is really, in a lot of ways, the key 2 or 3 pages in a 40-page agreement. So in a corporation, and this is why it's complicated because people think of it, people confuse LLCs and corporations. In a corporation, you'd have layers of preferred stock. So Series A preferred gets this amount of dividends, and they get paid back first if the company dissolves. And then the Series B might get a little more, but they get paid back less. And how those are priced is what the bankers get paid to figure out.
Yeah.
An LLC really does let you explain it more directly. So that's the money in a nutshell. Then there's the tax. And by this point in the agreement, most people are asleep. Most lawyers are asleep. It's great reading at 2 a.m. when you wake up and you don't want to go doom scrolling on your phone. LLCs can get taxed in 2 different ways. They can get taxed as a partnership. They can get taxed as a corporation. If it's taxed as a corporation, the earnings of the LLC kind of stay in the LLC for tax purposes unless they declare dividends or somebody gets a paycheck. In partnerships, and I would say most LLCs that we come across are taxed as partnerships. It's a lot more complicated. The idea is at a simple level that every item of net income and net loss gets passed through somehow to the partners on their individual tax returns. So you get something called a Schedule K-1 that gets stuck on the back of the partnership return that everybody gets, that specifies all this stuff. And how that happens, how that income gets divided up, is the subject of a whole class in law school. Not as important as it used to be in some ways. Before my time, really, in the heyday of tax shelters in the 70s and 80s, tax allocations really drove the bus. The idea was that they called them doctor and dentist funds. So people who had income coming in didn't have a lot of losses to offset it, would invest in these like real estate development projects that would generate huge losses for the first 5 or 6 years, and people could use those losses then to offset their other taxable income and reduce their income down to nothing. Congress caught up with that, and you can't do that anymore quite as much. So sometimes taxes still drive the bus. Most of the time, we want the taxes to follow the money. I don't want to go into huge detail on this because it's really complicated. If there's anything messy, I'm a business lawyer. I speak some taxese, but I will always work with a tax lawyer to make sure we're doing it the right way. So the goal is to have something called substantial economic effect, which is making sure that taxable income or loss is allocated to people on their K-1s in accordance with the underlying economics of the LLC. One concept that people sometimes get confused by, the way that you measure what that economic effect is something called a capital account. It's required by IRS rules. And the capital account is just some notional account that the accountants have to create that keeps track of what you put into the business, what you get out of the business, and any taxes that get allocated to you. So, or any taxable income or loss that gets allocated to you. So one of the things that happens is you're starting up a business, you are putting it into an LLC form. You may want to hold some money back and just to, for cash reserves. As soon as the business earns that money, that shows up on somebody's tax return because it is allocated. Same thing with losses. With financial investment partnerships, it's not as much of an issue, but it does happen. What do you do about that? You put a provision in that says the LLC will distribute out enough money each quarter to let the members cover their quarterly estimated taxes. And that's a whole discussion in itself on how you calculate that.
Yeah. It's a lot of information for folks out there. Jeff, I thank you for the time. So we're breaking it up into 2 episodes, right, Jeff?
Yes, sir.
Thanks for the time, the insights. I appreciate it as always.
So thank you, Mike.
That wraps up today's episode of Partnered Up, Business Law, Deals, and Dynamics. If you want to learn more, you want to connect with Jeff and the team over at Corin Lichtenstein, do me a favor, visit cl-lawgroup.com today. One more favor, as always, like, subscribe, leave a review, comment, share the episode with someone who needs to hear it. I'm Mike Leon. We'll see everybody next time.
Thanks for watching. Be sure to hit that like and subscribe button and leave us a review in the comments.